In this video, we show you how a portfolio of going private transactions constructed using evergreen equity splits can be used to program fiduciary returns that match fiduciary obligations for stewardship investors. To show you that this works with real companies at scale and across the entire network of our economy, we have picked three large market-leading companies in three different economic ecosystems, one in branded consumer products, another in industrial services, and a third in information technology. Procter & Gamble is our consumer brands example. Schlumberger, an oilfield services and pipeline company, is our industrial sector example. Microsoft is our technology example. Each of these companies is currently trading in the public markets. We are showing you here how equity splits can be used to take them out of the buy-sell paradigm of speculative valuation and bring them into a new cash flow sharing paradigm for more effectively and efficiently delivering programmed returns to fiduciary portfolios. For each sponsored enterprise, we show you here the amount of fiduciary funds being invested, and immediately below that, we show you the splits in the cash flows that will be flowing into this portfolio. Please note these numbers are all representing billions of dollars. This is a very large portfolio. The total investment is $353.42 billion, and portfolio cash flows start at $42.28 billion and grow to over $67 billion. You will see here that we do show the modeled returns for the first 5 years and then selectively for years 10, 15, and 20. This is in the interest of space to keep the presentation compact. We do stop our modeling at year 20 because that is the limit of our base case. Within that period of time, we are expecting to exceed our fiduciary returns, fully recovering the corpus of invested funds while continue to fund the associated fiduciary obligations. As these arrows indicate, each of these sponsored enterprises is expected to keep operating beyond 20 years, and the equity splits will continue to pour cash into the portfolio. This is why we sometimes call them evergreen equity splits. They are like a gift that keeps on giving. You can see down here that by year 20, all the invested corpus has been recovered, but the equity splits continue to pour cash into the portfolio. At this point, all that cash is available to fund fiduciary obligations because all of the corpus has been fully recovered. That, of course, is much more than is actually needed for those obligations, and so a surplus is created. And this is the actual design principle of the evergreen equity split, to generate more cash than we need to sustain corpus plus benefits, and to keep that cash flow pouring into the portfolio for as long as the sponsored enterprises remain competitive in their own commercial markets. And so now returning up here to the summary, you can see that the equity splits grow over time. This reflects an organic growth assumption included for each company in its own base case. This is in part how the IRRs grow to 6% by year 10 and keep growing to 13% by year 20. Note these IRRs are based only on the equity splits that are being paid out by the sponsored enterprises into the portfolio. The total cash flows within those enterprises will of course be higher. How much higher depends on how well actual results match the base case. In a properly constructed base case, actual results should always exceed modeled expectations by a comfortable margin. That excess goes to the leaders of the enterprise as their reward for doing what it takes to get corpus plus benefits paid out to their stewardship sponsors according to this agreed program. The next line here shows the total amount of fiduciary funds invested in this portfolio. You can see we have kept this amount constant in each year. Just to keep things simple, we have not compounded for inflation. That is not an oversight, it is a deliberate choice. For this exercise, we did want to avoid the complications that can arise when reinvestment gets modeled in order to support an inflation assumption. You'll see we also do not reduce this number for investment recovery. In our program, fiduciary obligations are calculated as a percentage of corpus originally committed to the portfolio, not just on the funds that are still at risk within the sponsored enterprises. Here we have identified three line items that make up fiduciary obligations. As we just discussed, the first, for inflation, we've intentionally omitted, so that's set at 0. This leaves us with a payout of fiduciary benefits, which we have budgeted at 5% of corpus committed to the portfolio, and costs for fiduciary administration, which we have budgeted at 1% of committed corpus. This gives us the sum of $21.21 billion that this portfolio must generate each year just to sustain its ability to pay benefits, assuming the associated corpus is held steady at the original $353.42 billion. In reality, this number would have to increase each year for cost of living and other such factors, but we have kept it flat, as we've said, to keep the presentation that much simpler. So here we bring down the cash splits pouring into the portfolio each year and apply a portion to the planned recovery of invested corpus here, with the remainder then being available to pay fiduciary obligations here. This is what we mean by matching fiduciary returns to fiduciary obligations. Compare this to our historical experiences with public market portfolios, which for stewardship investors really only began in the 1970s. There, longevity is matched to the liquidity of transient ownership. Valuations are fleeting, and paper profits in one accounting period can evaporate in another, driving a recurring pattern of booms that always eventually go bust. This happened most recently and very dramatically in 2008, but it is a constant reality when mismatching longevity against liquidity, because net asset value is not a return. This line here shows that a surplus each year is generated in cash available over cash required. Of course, this is what we really want, to generate this surplus. Some of this surplus would have to be absorbed by inflation, so maybe in the early years you'd find real surpluses much smaller to perhaps not at all. But over time, as the program for corpus recovery runs to completion, while the equity splits keep pouring cash into the portfolio, these surpluses do become quite large, very real, and more or less enduring. That is matching longevity to longevity. The impact of equity split surpluses is shown here in this final matrix of calculations, where we bring down for each year the amount of cash programmed for recovery of corpus here, add to that the amount of surplus cash left over after fiduciary obligations are satisfied here, to show the amount of fiduciary funds available in each year for new investment. Here we also show how these funds accumulate over time so that the portfolio corpus grows to $653 billion of the original $353 billion. But what we want you to appreciate here is that this annual amount available for reinvestment, other than keeping pace with inflation, does not actually have to be invested in order to support corpus plus benefits. The original investments will continue to pour cash into this portfolio, supporting fiduciary obligations to the limit of the base case, and then going on beyond that base case, whether any of the recovered corpus or earned surplus is reinvested or not. Consider for a moment now the power that this gives the capital steward. If corpus is protected and benefits are already funded, new investments can be pursued based on the impacts they will have. Some new investments will be selected for their positive financial impacts on fiduciary funds. That is good stewardship. Others can be selected as much, if not more, for their positive impacts on society. That also is good stewardship. So in this way, you can see why it is that we say that evergreen equity splits are good stewardship.